It's Tuesday, 30th of June, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every market trading day. Right now, if you look at the foundational macroeconomic data driving Indian markets, you are staring at this massive structural contradiction.
Right. Yeah, it's a complete
I
divergence.
mean, we're seeing this stark contrast between heavy industrial growth and, well, severe agricultural distress.
Yeah.
Let's look at the industry side first. India's industrial production, the IIP, it just surged to a multi-month high, growing by over 5% year on year.
And when you break down that momentum, the drivers are incredibly clear.
Yeah.
It's heavily fueled by this massive jump in power output, which shot up by 9%.
Wow, 9%.
Exactly. And alongside that, you have strong manufacturing growth clocking in at over 5%. So, I mean, when factories are pulling that much power off the grid and the assembly lanes are moving at that pace, it signals a highly robust urban engine. The
Yeah.
wheels are absolutely turning.
But, the moment you look away from those factory floors and pan over to the rural landscape, the agricultural sector is just flashing bright red. I mean, Kharif crop sowing has declined by nearly 23% year on year.
Yeah, that is a massive chunk of the planting season just completely missing. It's a severe contraction,
Right, and it's all about the monsoon.
right? It is entirely dictated by the monsoon.
Mm.
We are tracking a severe rainfall deficiency that has crossed the 40% mark in key regions. And, well, when you have a deficit that steep, the topsoil is just too parched for seeds to germinate.
So it's not just a slight delay, it fundamentally compresses the whole growing season.
Exactly. A shorter season directly threatens the final yield, which means supply constraints are already being baked into the next harvest cycle.
And look, you don't even have to wait for the next harvest to feel the pain because this lag is directly translating to your wallet today. Take a look at your grocery bills.
They're brutal right now.
Right. Average retail tomato prices spiked 18% in the past month alone. Onions jumped 11%, and even potatoes have crept up over 1%.
Yeah, it's a huge squeeze.
But here's the bizarre contrast. While vegetable prices are squeezing households, the organized dairy sector is projecting revenue growth of 13% to 15% this fiscal year. They are seeing sustained demand that is just completely offsetting their rising raw milk procurement costs.
It's fascinating, honestly.
So are we operating a two-speed economy here? You've got factory floors humming, farms parched, vegetables skyrocketing, but people are still buying premium dairy. I mean, how long can the urban consumer actually absorb double-digit vegetable price hikes before household budgets just snap?
Well, you're pointing to the exact tension of a two-speed economy, which, frankly, is a highly volatile state to sustain. On one hand, you have industrial resilience, which keeps urban wages flowing. But food inflation is, it's insidious. It acts as a highly regressive tax.
Right, it just eats into everything else.
Exactly. When your budget has to suddenly absorb an 18% spike in tomatoes and an 11% jump in onions, that capital is siphoned directly away from your discretionary spending. You might delay buying a new smartphone to cover the grocery bill.
But they're still buying paneer and milk, given that 13 to 15% dairy growth projection.
Right, the dairy projection is an anomaly because it shows consumers are, for now, prioritizing essential proteins, but there is a hard ceiling. If that 40% rainfall deficit isn't corrected, the resulting supply squeeze bakes structural inflation in for quarters.
And eventually, urban consumers scale back on manufactured goods.
Exactly, and that stalls the very industrial engine we just saw printing 5% growth.
And that fear of a squeezed consumer budget isn't just theoretical for households. It's exactly what spooked investors on Dalal Street during the previous trading session. We saw a broad pullback.
Yeah, Indian markets ended in the red based on previous closings.
Right. The Sensex shed nearly 0.5%, specifically down 0.48%. And the Nifty dropped right alongside it, down 0.46%.
What you are seeing there is a collision between domestic reality and global fear. Investors are engaging in broad profit booking, essentially taking their chips off the table.
Because they're looking at domestic inflation risks layered over global issues, right? Like the geopolitical instability in the Middle East.
Precisely. When domestic wallet squeeze meets global uncertainty, capital naturally seeks a defensive posture. It pulls back from riskier equities.
Well, let's look at exactly where that capital fled from, because the top losers make for an incredibly interesting read. IT firm Persistent Systems plunged over 11%.
That was a huge hit.
And what really stands out is the executive reaction. The CEO basically brushed off the double-digit drop, claiming future growth from their recent Nagaro acquisition will eventually reward investors.
I mean, wait, isn't that like a ship's captain ignoring a massive leak in the hull because they just bought a slightly larger sail?
That's a great way to put it. I mean, the market sees the leak and simply doesn't care about the new sale right now. Executive optimism in the face of double-digit market punishment always looks like denial to the institutional investor.
Because their timelines are completely mismatched. Exactly. The CEO is modeling the synergistic potential of an acquisition over a multi-year horizon. But the market is pricing in immediate execution risk and a current global tech spending slowdown. An 11% drop is the market screaming that it is deeply skeptical.
They want the core business stabilized, the hull patched, before they assign any premium to a new acquisition.
Right, especially in a high interest rate environment.
And we saw significant pain elsewhere, too. NetWeb Technologies fell nearly 10%, and Astral dropped over 8%.
But despite the broader sell-off, we did have some major gainers completely defying gravity.
Oh yeah, Borsil Scientific surged over 13%. Ramco Systems rallied almost 12%, and Zydus Wellness climbed over 10%.
Which proves that even in a heavy profit-booking environment, capital is rotating, not just exiting the system entirely. Investors are brutally punishing perceived overvaluations, but they are heavily rewarding companies with unencumbered growth trajectories.
Speaking of unencumbered growth, or, well, the lack of it, we have to talk about the primary market reality check. Insurtech startup Turtlemint had a highly disappointing debut, listing at a discount of over 11%.
Yeah, Turtlemint's discounted listing is a perfect case study. It is exactly what happens when private venture capital valuations violently collide with public market scrutiny.
Because VCs price based on hypergrowth projections down the line, right?
Exactly. But when you hit the public markets, especially in this cautious, profit-taking environment, retail and institutional investors demand clear, immediate paths to profitability. A double-digit discount at listing basically vaporizes those early venture paper gains.
It's a massive signal that Dalal Street is flat out refusing to pay that aggressive growth premium startups got used to.
Absolutely.
Now, capital isn't just reacting to domestic inflation or VC overvaluations, it is reacting to the global chessboard. We have to pan out to commodity markets because they're dictating these domestic swings.
They absolutely are.
In commodities, Brent crude oil dropped around 1%, and that follows a massive plunge of nearly 11% just last week. Gold and silver both dropped over 1% too.
You know, the movement in crude oil is the single most critical variable for your portfolio right now. It's the primary transmission mechanism between global risk and Indian domestic inflation.
Because we import the vast majority of our crude, so every swing hits our trade deficit.
Yeah.
But explain the crude oil paradox to me here. Why are oil prices dropping by double digits weekly while missiles are actively flying in the Middle East?
It's counterintuitive, right?
Totally. You read the headlines and expect a massive spike at the pump, but the price is cratering. How are physical shipping routes currently trumping this massive geopolitical panic?
What you are watching a real-time showdown between supply chain physics and market psychology. Geopolitical headlines generate instant panic, which usually forces traders to bake a risk premium into the price of a barrel.
Right.
But commodities are grounded in physical delivery. Despite the missile exchanges, actual energy shipments flowing through the Strait of Hormuz have recovered.
So traders are looking at satellite tracking, seeing the ships are moving, and realizing the tap hasn't actually been turned off.
Exactly. They aggressively price out that geopolitical risk premium. Physical supply fundamentally overrides the fear of disruption right up until a tanker is actually blockaded.
And the geopolitical landscape driving that fear is incredibly murky. Just sticking strictly to the facts on the ground, there is high diplomatic confusion in Doha right now.
Right, absolutely. It's a mess of messaging.
Yeah, the U.S., represented by Trump's envoys, claims a meeting with Iran is definitively set. Meanwhile, Tehran explicitly denies any scheduled talks.
And that conflicting messaging creates a complete vacuum of predictability for global markets. Market makers simply cannot accurately price in a diplomatic resolution when the signals are crossed like that.
So it forces traders to keep a baseline of volatility alive, even as those physical oil flows continue uninterrupted.
Exactly. You end up with a market constantly on a hair trigger.
Adding to that structural uncertainty, back in the U.S., the Supreme Court just handed down a ruling expanding presidential powers to fire officials at independent agencies.
Though they notably blocked the firing of Federal Reserve Governor Lisa Cook.
Right, which has massive ripples into global markets and foreign exchange. I mean, expanding the power to remove these officials alters how global markets view U.S. regulatory consistency.
But preserving the Fed's independence is the crucial firewall here. Think about the mechanics of the global bond market. Had the president been granted power to fire a Fed governor over interest rate policy, It would have instantly compromised U.S. monetary policy.
Global investors would immediately demand higher yields to compensate for that political risk, triggering a massive repricing of global debt.
Exactly. Mortgages, corporate borrowing, emerging market debt, it all would have spiked. The court keeping the Fed insulated prevented a massive liquidity shock.
And global markets are already reacting to shifting paradigms, especially in currency. The Japanese yen just slid to a multi-decade low against the dollar.
Which has put everyone on high alert for immediate government intervention.
Right. The collapse of the yen is just a masterclass in how ruthless interest rate differentials can be.
It really is. The U.S. Fed kept rates relatively high, while the Bank of Japan maintained incredibly low rates to manage their massive domestic debt.
Capital always flows to where it's treated best, so investors borrow cheaply in yen and sell it to buy higher-yielding U.S. assets.
And that massive outflow crushes the yen's value. Hitting a multi-decade low puts the Bank of Japan in a brutal bind. A weak yen imports massive inflation because they have to buy energy and food in strong U.S. dollars.
But actively intervening in FX markets to prop it up costs billions. And it's like catching a falling knife if that underlying interest rate gap doesn't close. We're seeing equally violent shifts in the corporate landscape globally, too.
Definitely. Look at Comcast.
Yeah, Comcast shares jumped over 21% in pre-market trading on plans to spin off its media networks. But the truly staggering metric is Microsoft.
Right, they just suffered their worst month since the dot-com crash.
Because AI profitability fears wiped out massive chunks of their market value.
Microsoft's correction perfectly encapsulates this violent transition from the hype phase to the deployment phase of a transformative technology. Over recent years, the market assigned astronomical valuations based on infinite AI promise.
But now the reality of the balance sheet is taking over. Investors are looking at the colossal capital expenditures, the specialized data centers, and asking to see actual revenue matching that spend.
And when enterprise adoption scales slower than anticipated, you get a violent correction. It's identical to the dot-com bubble, where they laid thousands of miles of expensive fiber optic cable years before broadband demand actually caught up.
The infrastructure was real, but the timing of the cash flow was wildly miscalculated.
Exactly.
And, that friction between massive technological power demands and the need for sustainable energy brings us to a perfect transition. We are moving from global dependency on oil and AI data centers to a groundbreaking leap right here in India.
The IGCR Kalpakkam facility.
Exactly. This could redefine clean energy independence. India has just inaugurated the world's first hydrogen plant that utilizes nuclear reactor heat instead of electricity.
It is a staggering engineering achievement that fundamentally alters clean energy economics. To understand why it matters, look at how green hydrogen is typically produced.
Traditionally, it relies on electrolysis, right? You pump massive amounts of grid electricity through water to separate the hydrogen.
Right. And the bottleneck has always been the sheer volume of electricity required. It makes the resulting hydrogen incredibly expensive and strains the grid.
But this new facility at Kalpakkam bypasses that electrical grid bottleneck entirely. It uses the extreme raw thermal heat directly from the nuclear reactor to generate hydrogen.
Exactly.
I mean, it's like cooking your dinner directly over a campfire instead of using that fire to power a generator to plug in an electric stove. You cut out the middleman entirely.
That's the perfect way to look at it. Every time you convert energy from thermal to electrical and then to chemical, you lose massive amounts of efficiency.
So by utilizing thermochemical water splitting, using that extreme raw heat directly, production becomes exponentially more efficient.
Right, you leverage an existing steady-state thermal baseload from the nuclear plant to create zero-emission fuel without ever pulling a single watt from a transmission line.
It completely changes the financial modeling for heavy industries like steel and fertilizers in India, which desperately need green hydrogen but couldn't afford the electricity costs to make it.
It does, and it leads to a truly profound geopolitical thought for you to mull over on your commute.
Oh, absolutely. Think about it. We spent the earlier part of this deep dive mapping out global oil dependencies, the anxiety over the Strait of Hormuz, the leverage of Middle Eastern states, and the inflationary tax on your household budget.
Right, and if India can successfully scale this specific nuclear heat hydrogen technology, it doesn't just lower domestic emissions.
It could fundamentally neutralize the geopolitical leverage of those oil-producing nations. If you can produce infinite, cheap, clean fuel domestically using your own nuclear baseload, you completely rewrite global trade dynamics.
You insulate your entire economy from every missile fired half a world away.
And just before you go, a quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.